The 7 laws of money and the system behind them. You can do everything the personal finance books tell you, save aggressively, invest early, work hard, and still feel like the scoreboard never moves. That's because most of what people call money advice is actually a list of habits. Habits help. But money itself runs on laws, not habits. Once you see the laws, the habits make a lot more sense. Here's the system underneath all 7. 3 jobs your money has to do. Momentum, how fast and how consistently the money compounds. Structure, who controls it and what outcomes that control produces. Asymmetry, how big the upside is relative to the downside. Every law below is really just a more specific version of one of those 3 jobs. Law 1, money loves speed, wealth loves time. 2 people, same market, same 5 years, wildly different outcomes. The first one flips houses. Buy, renovate, sell. Buy, renovate, sell. Repeat it 50 times over 5 years and you've made real money, but you've also reset the clock 50 times. Every sale ends the compounding. The second person buys one single-family rental. A couple years later, refinances and buys a small fourplex. A couple years after that, uses the equity to step into a 20-unit building. No flipping, just holding, refinancing, and stepping up. At the 5-year mark, the flipper has done more transactions and made decent cash. The holder owns 20 units outright and has a net worth several times larger, from doing less, not more. That's the distinction. Speed is the gap between spotting an opportunity and acting on it. Close that gap and money moves faster. Time is what happens after you act. The discipline to hold a good decision long enough for compounding to actually show up. Even when the first few years look unremarkable, people love to confuse the two. They think fast action guarantees fast results. It doesn't. You need the right speed on the entry and the right patience on the hold, and most people only ever practice the first one. Law 2. Whoever provides the capital controls the outcome. Founders who sell their company almost always leave more value on the table than the buyer captures. Not because they got a bad deal, because buying and building is structurally the better seat at the table. Look at how people actually land on wealth rankings. Almost nobody gets there purely on salary. A handful get there by selling one great company, but the overwhelming majority get there by continuously buying and building, acquiring assets, companies, or franchises, and compounding them over decades. The pattern shows up everywhere once you look for it. A social app bought for a fraction of what it's worth 10 years later. A video platform picked up for what now looks like pocket change relative to its current role in a much larger company. A struggling sports franchise bought for tens of millions that's worth well over $1 billion within 2 decades. The common thread isn't luck. It's that the person who brings the capital sets the terms. Valuation, structure, timeline, control. Sellers negotiate price. Buyers negotiate everything. This doesn't mean you need 8 figures sitting in a bank account before this law applies to you. It means the orientation matters. Are you positioning yourself, even in a small way, to eventually be the one bringing capital to the table, or are you only ever on the other side of that table? Law 3. Leverage multiplies whatever it touches, including your mistakes. Buy a $1 million house in cash, and it appreciates 10%. You've made a 10% return. Buy the same house with $200,000 down and $800,000 borrowed, and that same 10% appreciation is now a 50% return on your actual cash. Same house, same market. Completely different outcome because of leverage. This is the entire logic behind private equity. Investors bring a slice of equity, banks finance the rest, and the return on that equity slice gets magnified. It's the same logic behind a 20-unit apartment purchase, where a third of the price might come from you and the rest from a lender. Collateralized by the building itself, often without a personal guarantee, and frequently carrying tax advantages that cash purchases don't get. It's also the quiet mechanism behind how many high-net-worth founders fund big purchases without selling stock, borrow against an existing position instead of liquidating it. The stock becomes collateral, The loan produces no taxable income, and the founder keeps ownership of an appreciating asset while still accessing cash. 4 things worth knowing about leverage before you use it. It's the primary engine of economic growth broadly, which is exactly why it's so easy to underestimate. It comes in very different risk flavors depending on what's used as collateral. It's fundamentally a game of what happens if I default, so know your collateral cold. And because borrowed money isn't income, it isn't taxed, which is a real legal advantage, not a loophole. Leverage doesn't create wealth on its own. It amplifies whatever you already built. Good decisions get bigger. Bad ones get bigger too. Law 4. Cash flow keeps you alive. Equity makes you free. Cash flow pays today's bills. Equity is the thing that eventually lets you stop needing to. The clearest way to see this: a massive global fast food company makes plenty of cash selling food, but a huge share of its actual enterprise value sits in 2 other places: franchise royalties and the real estate underneath thousands of locations. The burgers fund the business. The equity is the business. If you can't own equity in your own company outright, the next best move is owning a slice of someone else's. Public markets exist precisely so that regular investors can do this. Either way, the objective is the same. Cash flow buys you time, equity buys you freedom, and confusing the two is how people end up doing fine for 30 years without ever getting ahead. Law 5. Risk and reward are not a straight line. A venture fund makes 5 $100,000 bets, $500,000 total, and that's the maximum possible loss. 2 of the 5 go to zero. 1 breaks even. 1 returns 10 times. 1 returns 100 times. That last investment alone returns more than the entire fund's original capital. This is the entire logic of portfolio construction. You're not trying to win every bet by a little. You're trying to cap your downside at a known bounded amount while leaving the upside completely open. $100,000 becomes zero, or it becomes $10 million. The loss is fixed. The gain isn't. Most people build their financial lives around symmetric bets. Put in $100, hope for $100 back plus a little. The goal is to find more situations where $100 in has a real shot at $10,000 out, with a downside you can actually survive. Law 6. Never risk the whole empire for one shiny opportunity. A couple spends 15 years methodically saving just over $700,000. They get introduced to a high-return energy investment, tax advantages, a strong pitch, a trusted friend involved. It looks like a rare, obvious opportunity. They put in everything. 2 years later, the deal collapses completely, and 15 years of savings disappear with it. The lesson isn't about that specific deal, or the friend, or the due diligence they should have done differently. It's about sizing. 15 years of savings should never be sized as a single bet, regardless of how good the opportunity looks on paper. There's a useful mental model here from portfolio theory. For a given expected return, your job is to find the version with the least risk, not the highest return in isolation. If 2 investments both return roughly 12%, but one carries meaningfully less risk than the other, the lower risk one is simply the better investment. Most people chase return and ignore risk entirely. The best investors do the opposite. They hold return steady and hunt for ways to shrink the risk underneath it. 2 takeaways. Protect the underlying machine that generates your opportunities in the first place, your income, your business, your core capital, before you ever swing big. And only swing big once your downside is genuinely capped, not just probably fine. Law 7. Diversification is what you do when you don't understand something. Conventional advice says spread everything across everything. Most people who've actually built significant wealth do close to the opposite. And the reason comes down to 2 variables: how well you understand the risk and how much control you have over the outcome. Understand the risk and have control? Concentrate. That's your own business, and you have every reason to know it better than any outside investor ever could. Understand the risk but have no control? Fine to hold a position. That's a well-understood public company you don't run. like a slice of an index or a name you've researched deeply. Have control but don't fully understand the risk? The fix isn't to sell, it's to bring in someone who does understand it. And when you have neither understanding nor control, that's precisely when broad diversification is the right call, not a consolation prize. This is why founders and operators so often keep the overwhelming majority of their net worth concentrated in their own company. It's not recklessness. It's that they have more real information and more real control over that one asset than over anything else available to them. Before you invest in anything, ask these 5 questions. 1. Can this compound? Is this structurally a long-term asset or a one-time transaction dressed up as an investment? 2. Who actually controls it? You or someone else? 3. What happens if it fails? Do you recover some of your capital, all of it, or none? 4. Is the upside meaningfully larger than the downside? Or is this a symmetric bet pretending to be an opportunity? 5. Do you genuinely understand the risk? Could you explain in one paragraph exactly how this makes money and exactly how it loses money? The laws don't tell you what to buy. They tell you how to think about anything you're considering buying, which is the more durable skill.